Hello, everyone. Welcome to another 21 Hats Dashboard. Every Monday, Gene Marks and I talk about the issues we think business owners should be monitoring this week. Gene is president of the Marks Group, a consulting firm that advises small businesses, especially about their technology needs. He also hosts his own podcast, Small Biz Ahead, with the Hartford Insurance. You can find it at sba.hartford.com. Welcome, Gene.
Hello, Loren. Great to be back.
Great to be here with you. Let's start today, Gene. You had a really interesting piece that ran this week, I think in The Hill. The last couple of years have actually been, they've been a mess in all sorts of ways, but they've been great for entrepreneurship and startups. We'd been through a kind of a dry period. There've been a lot more startups, but you wrote this week that you think the party's over. Why is that?
Yeah, you're right. There has been a ton of startups over the past really year and a half, going on 2 years. And 2020 startup applications filed with the Census Bureau were like 20% ahead of applications from the previous year. This is during the pandemic year. And then this year they're on a similar pace. So you've got millions of people filing these startup applications. There's a lot of discussion as to why that's going on. There's a lot of people sitting at home. Some people had to start up businesses because they're unemployed. They had to.
Yeah, it was out of necessity. It was.
Yeah, it was certainly out of necessity. I think that's certainly one of the reasons. There's always, I think there's a few reasons why. One of them, others is I think all those corporate employees that pretend they're so busy and slammed all the time is not exactly, they weren't as busy as they were saying they were. They have time to start up, little side gigs and what have you. The venture capital industry has also been going like bonkers. I mean, venture capital investments are about 150 billion last year in U.S. U.S. companies. This year, it's already 140 billion year to date. Looks like it's going to exceed last year's number. It's all great news for entrepreneurs. Loren, I think it's going to end, and it's going to end pretty soon. Not like completely stop, but I think the party is going to be tapering down.
Why?
And ask me why. Go ahead.
Why, Gene? Why do you think that?
The reason why there has been so many businesses starting up is, one of the reasons why, the biggest reason why, is that there's been a lot of capital. There's been a lot of savings, but more importantly, there has been a lot of capital available for business owners to get a hold of. And particularly in the venture industry, there's been a lot of capital available. That's because interest rates for the past God knows how many years now, 10 years at least, have been rock bottom. So, the cost of capital has been extremely low. And venture capital firms have been able to raise capital with the enticement of giving their investors more of a return than putting it certainly in the bank or putting it in the stock market where, you're at the mercy of other people managing your money. And I think that is, that's been a big, big reason why so much capital has been available. That's going to go away. And the reason why is inflation. We're seeing inflation rise all over the place. There's a lot of money circulating in our system. Our bank reserves, our M2 money supply is up $4 trillion in just a year. Lots of stimulus money being spent, supply chain issues, other price pressures. At some point, the Fed is going to jump in and start raising interest rates. And when that happens, it's going to happen longer term. And right now we've got interest rates of about 2 to 3%. I think that's going to at least double over the next year, if not go up even more than that. And as the cost of capital goes up, it's going to be more expensive for people to raise capital and therefore to invest in startups. I just don't think there's going to be as much capital available for all of these startups. And that's one of the prices we pay for high inflation is I think it's going to hurt innovation and startups in this country. And, I think we're going to see that play out in the next 6 to 12 months.
Well, let me ask you about that. I'm curious about one aspect. I mean, to a certain extent, what you're saying is, there's just no question. But there is inflation. Everybody expects rates to go up, and business owners do not like interest rates going up, and it's going to have an economic impact. And that just is what it is. That said, I'm curious whether there really is that much of a tie between interest rates and startups, especially the number of startups. I mean, the cliche we all know is of the entrepreneur who starts a business by maxing out 12 credit cards.
Right.
That person clearly isn't worried about interest rates.
Right. Well, actually, they are if credit card rates go up. Because
if you're starting your business with credit card money, you're paying very high rates already. And another point or two isn't going to make much of a difference. I wonder, here, let me ask it a different way. As you said, interest rates have been low for quite some time. They were low before the pandemic when there were not that many startups.
Let's talk about the difference between startups and startups that grow and sustain. The startup numbers that I talked about earlier include a great number of side gigs, people selling on Etsy or Amazon resellers, or even Uber drivers, going to be starting up their own businesses. I don't think interest rates aren't going to really impact those people that much, but for the startups that turn into bona fide companies that employ people and grow and contribute to the economy in a more significant way, those startups at some point, whether they got credit card financing or bootstrapped or whatever, at some point they will need capital to reach further levels, stages of their growth. And many of them turn to venture capital firms, private investors, as well as as banks. For more, on a traditional side, for more mature companies. So, for those companies, and those are the companies, the Silicon Valley companies, the tech companies, the people that are in Silicon Alley in New York and other circles in the country, they're going to try to raise capital to do this, and they are going to have a harder time raising capital because there just won't be as much capital available because the cost of that capital is higher. And because of that, there will be, investors will be less attuned to taking the risk. I mean, if interest rates are that high, a lot of times investors, they invest based on margin. So they're borrowing money to invest. Other people are also looking for other options to invest their money for a return. For the past 10 years or so, we've had few options to invest our money other than the stock market, which is why so many investors have gone out into the private equity market. But as interest rates go up, one of the good things about it is that, it increases the returns on, say, treasury bills and government securities, savings account, money market accounts. There's other options. And I think people are going to be putting their money in those places, and, because it's less risky and still provides a satisfactory return to them than having to turn to venture investments or angel investing. And I think that those startup companies are going to find themselves without the capital they need.
Interesting. I think it's such an important issue. I don't think we necessarily completely understand why there were so few startups or declining startups during that period before the pandemic. And I'm not sure we completely understand why the number picked up, although obviously, the people who started businesses out of necessity, clearly that was a result of the pandemic. I think it's important for us to try to understand going forward what the situation is and whether the increased entrepreneurship will go on. If I hear you correctly, I think what you're saying is it may not be so much about the number of startups, but kind of the quality and the long-term sustainability of those startups, the ability to go from starting a business to really building a sustainable business.
Yeah, I think you phrased that right, Loren. I mean, there are a lot of people that start up side gigs to do stuff, and that's not really what I'm talking about. I'm talking about companies that are starting and plan to grow and hit further stages and employ others, and become bona fide, entities. Those are the ones that are going to be searching for capital, and those are the startups that are going to wind up having a real struggle getting that capital.
All right, let's go to story number 2. I was really, I was really caught up in this story today. It ran, last week, Friday's Wall Street Journal. There was a story. It was a case study of a business trying to raise its prices, and I'm always a sucker for pricing stories. I think it's really interesting. Yeah. I don't think, it's something that everybody struggles with. It's such a psychological problem. Everybody knows that lots of small businesses price poorly and many go out of business because they don't charge enough for what they're doing. And it's easy to tell them you should charge more, but it's different when you're sitting in that seat and you're the one that's afraid that if you increase your prices, everybody's going to run in the other direction. So This is a story about the owner of a movie theater chain who decided to try going with a special deal where you could pay a certain amount just for the ticket price. But if you pay $25, you also get all you can eat. And we all know how easy it is to spend money on food, quote unquote food, at a movie theater.
Yeah.
It didn't go well for him. And I thought it was a really interesting piece. Did it strike you as well?
Yeah, it did. And first of all, your comments on pricing are so right. I mean, all the clients that I talk to, obviously you say, what's your biggest issue? And people are like, finding people. Okay. But every client has a hard time with pricing. Nobody knows if they're charging too much, too little. It is, I know it's like the market can bear, but it is, you ask any business owner and, how they come up with their pricing, and it's never quantified. It gets to so they take their costs and then they put their thumb in the air and they're like, okay, we're going to bump it up 20%. We hope that that's right. I tell you, Loren, if you ever want if you want to write a great book, because I don't have the time to do this, but I don't know if you have the time to do this, but it would be fascinating to interview, a half a dozen, academics, pricing experts around the country and lay it out for a small business owner to really give them, 5, 6, 7 pricing strategies for their business. Just a book on pricing, because it really, and it changes so frequently. It's not like you can go back to the same book written 10 years ago, because a lot of things have changed. But, so this person that runs a theater, he's trying to figure out if this all you can eat, option is going to work for him. Good for him that he's giving it a shot. I mean,
absolutely.
You can't, right. And it's not like he went out of business because of it. I mean, it was just, it was a deal that he tried.
I think that's a great point. It's so important to try to experiment, and it doesn't necessarily have to be fatal.
Yeah, it really doesn't. You can always pull it back. I mean, if the pricing is wrong, or if he's not making money, it's, you can always go back. And I've written before in the past of people that run buffets. There was one restaurant owner, it was in China somewhere. It was a hilarious story that he put up like an all-you-can-eat kind of deal at his restaurant and went out of business because of it. There were like so many people lined up outside the door. And I don't know the difference in Chinese society. I guess you make promises, you got to keep them, and therefore you went out of business. Whereas if it was me, I'd be like, all right, this isn't working. I'm breaking the promise right now. But I give the guy credit for giving it a shot. Like I said, it didn't put him out of business. I would encourage him not to give up and try and come up with other scenarios for pricing. But again, do you notice it's like what we all do. It's like he's giving it a shot. It's not like a data driven thing. It's not it's just,
there were some things that he probably should have seen coming based on the story. And one of them is there's a pretty funny part of the story where he got a bad Yelp review from somebody who pointed out that if you didn't take the all you can eat deal and you just bought the ticket, you were not allowed to just buy a soda or just buy popcorn. You couldn't have any food. And on the Yelp review, the person wrote, "What brainiac thought of that?" And the story quoted the owner as saying, "Well, actually, I'm the brainiac who thought of that." And I give him credit for owning up to it.
Issues.
Yes.
I mean, that also brings up the point about testing out, whatever pricing change. I mean, among your friends and colleagues and, and advisors, like, is there anything that I'm missing? The best scenario of pricing that I've seen in my experience is Major League Baseball. I mean, I interviewed, it was a couple of years ago, it was the VP of marketing at the St. Louis Cardinals. I forget the name of the guy. And he was explaining to me the MLB's pricing, because it's all kind of dictated from the MLB, but then down to the individual teams. And if you go on, the Cardinals website to buy tickets, the prices of a ticket change depending on the
dynamic
team.
Pricing.
Yeah, it's dynamic.
I didn't know baseball was doing that.
Yeah, they are doing it, and they've been doing it, and it's been a very successful thing. And some travel and bus companies, for example, do the same thing. Like Bolt Bus and Megabus and those companies as well also do dynamic pricing. I mean, that is really the way to do it. The problem is with a small business, obviously, because number one, we don't have the resources. Number two, we don't have the volume, to justify that kind of a thing. Do you know what I mean?
Sure.
So it's really hard for us to come up with like a similar type of methodology. But that's
and
the
also
way to do it.
the lack of resources. I mean, a big company can experiment, and if it doesn't work, the losses are probably manageable. With the small business, you often, in a quick test, you may not really be sure what the lesson to be learned is. I mean, even with the movie theater guy, maybe the movies weren't that good. Maybe COVID played a role. He also said in the story that he wasn't sure he tried it at the right location. And I don't know what he was thinking about, but, he has a chain and maybe he should have done it somewhere else. There are a lot of variables, and it's who's to say definitively what was, the most important factor.
100%. But like I said, good on him for trying. And I hope he continues to try and it doesn't discourage him. I just think my only advice to him would be, if you're going to make any pricing changes, bounce it off of as many people as possible before you implement it, and be transparent about it. You know what I mean? Like whether he has a Facebook page, communications with his audience, let him know that this is a new pricing structure, but give me feedback and be prepared to change it. That's all.
Story number 3, there was a story again in the Wall Street Journal that consumer confidence is sliding. How do you think about that? I mean, this is the third month in a row, September was, that indicator is falling. We had thought back in the spring that we were headed in the right direction. The economy seemed to be booming. What do business owners take from this?
I could tell you, I think it all comes down. We've been having this whole conversation has been about inflation, because that's really what's going on here. And that is what's eroding consumer confidence. I think you're right. Back in the spring and early summer, people were excited. We're getting shots in arms. We're going to go out and resume normal life. The economy's going to boom back. And a lot of people did. In the spring and the summer. I mean, after being holed up for a year, it's nice to go out to eat and all of that. But I don't know if you're seeing the same thing, Loren. Like I go to restaurants. I was just at a bakery across the street from where I live. That they put a sign up on their doors apologizing because they've had to increase their prices because of the price of their materials have gone up. And I'm seeing that all over the city in Philly where I live. Restaurants are having to increase prices, and I think consumers are feeling it. I mean, we're noticing it. We see this is really expensive to go out to dinner, like more than before. Jesus, I'm paying $23 for a plate of pasta. I mean, there was only $18, a few months ago. So
I think I'm paying twice what I was paying for toilet paper.
Yeah, I hear you. I mean, it's not. I mean, you can really, if you start looking at what you're paying for now versus what you paid for it a year ago, a lot of companies are they're raising prices, and I'm telling my clients to raise prices whether they need to or not, because we're in a situation now where you can get away with raising prices. But
it's kind of the easiest time ever, isn't it?
It really is. But consumers are noticing it because we ain't stupid, and because of that, where people are holding back a little bit on doing things and buying things, and businesses. A lot of my clients are doing the same thing. They're they're limited in what they can spend.
Let me ask you this: I think initially there was the hope and some guidance from the Fed and economists and other places like that this was mostly supply chain driven, pandemic driven, and that it wasn't necessarily going to stick around.
Right. Just
recently, the Fed has said, well, it's probably going to stick around a little while. We're going to have higher inflation, at least into next year. But, a lot of it clearly is still driven by supply chain issues. I mean, the car situation is just unbelievable.
Yes.
What it costs to buy a car or to rent a car, if you can even find one. That problem is going to be solved eventually, I would think. How do you look at it in terms of what's here to stay and what's...
I think once prices have gone up, they're going to stay up. I can't see, I think
Really,
once a restaurant...
the average price of a car, I think, is now $35,000 or something like that.
Yeah.
And you think it'll stay there?
Once prices hit a certain level, it's, for them to start going back the other way. And the same thing with wages, because I think that's what's going to happen next. I mean, hourly wages have gone up about 4% in the past year, but certain industries are reporting increases significantly more than that. People in the travel industry and the service industries are reporting 10% increases in wages. Once you increase wages in your company, you're not going back on that. You can't say you're going to pay somebody X dollars and then 6 months later come back and say, okay, we're now going to reduce that. So that puts a whole new level of costs on an overhead structure for all businesses, and those costs have got to be absorbed by customers, which means that those higher prices they're going to be here to stay. Now, the rate of inflation might decrease after a year or so. I mean, that's certainly going to happen. But, what a lot of economists, and I'm worried about, is just so much money floating around in the system, Loren. I mean, there's, again, so much money on reserve with our banks. There's so much money that's been scheduled to be spent through stimulus payments. I mean, it's Monday today, so Congress is still talking about all the different things that they're going to be spending money on between infrastructure and Build Back Better and all of that. It is, there are potential inflationary impacts for doing all of that stuff, and that's going to continue to have an impact on prices going forward. That's a concern.
So we started talking about this because of the impact it's had on consumer confidence.
Yeah.
How do you look at that? How do your clients look at that as they plan spending for months ahead? Are people reining things in, or
right? There's
what do you say?
No question that consumer confidence. Now, there's two big indicators for consumer confidence. One is from the Conference Board, and the other is from the University of Michigan. Those are two good metrics to follow. And you just mentioned that's the third month in a row, and that's the key. You can't take a metric just in isolation. You got to look at where the trend is going. And we've had 3 months in a row of declining consumer confidence. In the end, everything is bought by consumers. I don't care if you're in the packaging business or you're making corrugated containers or you're, paper and film. In the end, it gets consumed by consumers. So when you see consumer confidence, starting to go down, that's a big concern for businesses all across the board. I'm not seeing my clients respond to that yet, but they're wary of it. They're keeping an eye on it, as well as other metrics that they're keeping an eye on.
Anything in particular that you would call to our attention? Yeah,
there's a few metrics that some of the smartest business owners I know that they watch. Now, during COVID, there are some high frequency indicators that people are really, I know a few clients are really keeping an eye on and we're still in this COVID environment. So a couple things, to be aware of. Open Table publishes every week their reservations on their system. OpenTable is that mobile app, that you can use to make
sure.
reservations all across the country. They do it by city, and then they do a national average, and it gets graphed out and compared to the levels in 2019. So it's important to see if people are spending money at restaurants, because if they're spending money eating out, that means you're spending money elsewhere. So OpenTable, the restaurant reservation index has been a really reliable one during COVID. The other one is TSA Travelers, the Transportation Safety Administration. They publish, or Security, Safety, whatever, TSA. They publish that every day, and they show travelers going through the airports compared to the same time in 2019. Both those levels, by the way, reservations and travelers, are still below 2019 levels. We should be in growth mode, but
I think they're also trending down a little bit from previous months, right?
They are. So, a really good place to go to see those metrics, by the way, it's a wonderful blog that I follow called Calculated Risk Blog. It is run by, a guy that's been doing it for a number of years, and he takes that data every week and he graphs it for you, so you can see the trends as to where it's going, because that really gives you also a good indication if people are traveling. That has direct and indirect effects on so many businesses. And then, of course, if people are eating out, that also has direct and indirect effects on many businesses. And then there's other monthly indicators that I know a lot of my clients like to follow. Small business confidence from the NFIB is really important. You mentioned consumer confidence, but small businesses, when they're feeling good, I mean, there's 30 million of us, employ half the people in this country, generate half the GDP. When we're feeling good, that's a good news. But if that indicator is trending down, that's also a worrying sign. And then the other good one that I recommend following, the Institute of Supply Managers puts out a monthly two metrics, one on business conditions for the manufacturing industry and business conditions for the services industry. The Institute of Supply Managers is an association of purchasing managers, and they survey those people and they ask them the obvious question: what are you buying and how much over the next 30, 60, and 90 days? Because if purchasing managers are buying, that's a good sign for the economy. And then they break it out between manufacturers and service industry. They publish it once a month. It doesn't get major media attention on ABC News, but a lot of the economists that are tracking the economy look closely at those metrics.
We're just about done here. Can you give us a hint? How's it looking right now?
It's softening, both
Yeah.
of them. I mean, it has been it has been significantly growing throughout the summer. It was really strong numbers, and now over the past 2 months, those numbers have softened a little bit. So you have to keep a close eye to see if any significant drops happening. And I do want to say that Loren, there is none of these indicators I look at are panicking me. They're not dropping off to precipitously. It's just
right.
They're just not growing at the level that we were hoping that they would grow. And I think it's because of two things. I think it's because people are still not. They're still wary about going out and
for sure
going to work and spending, and and even for the people that are going out, the supplies are not there. It's both materials and labor are short supply.
A lot of great tips there. Thank you, Gene Marks. It's always a pleasure speaking with you.
Love to speak with you, Loren. Look forward. We'll talk next week, right?
Absolutely. You can learn more about Gene's business at marksgroup.net, and you can hear his weekly podcast, Small Biz Ahead, at sba.hartford.com. Have a great week, everybody.